The move to passive investing has been a powerful trend, but we think it's important to define what we mean by passive. When used in the industry, it normally refers to the replication of a market capitalization weighted index, while active describes everything else. We can also apply this definition to asset allocation, with passive defined as holding the entire investable market in proportion to the size of each asset class. Few, if any, investors actually do this. Therefore, almost every investor is active on some level. Furthermore, as Lasse Pedersen has pointed out, replicating an equity index such as the S&P 500 is not strictly passive, since trading is required to match the constituents of the index. In this sense, the connection between buy and hold investing and passive investing can be misleading. With the rise of ETFs to implement asset allocation, and looked at through this broader definition of active, the share of actively managed assets may not have declined as much as shifted from security selection to asset allocation. That is, those buying ETFs aren't buying them for keeps. They're using them to express an active investment decision, and often trading them frequently, invalidating the term passive. On balance, we think this shift in active management increases the opportunity to outperform for investment managers who are able to take broader views on asset classes, sectors, and industries. These types of views tend to be more uncertain and can take longer to play out, requiring greater patience due in part to the challenges in standing against them. Patience often relates to time horizon, and while rewards tend to come for those who wait, it may be even more challenging to be patient. This is because holding periods have been declining, and arguably shortened by the rise of passive management, which appears to be a contradiction given passive funds have low turnover rates. If index tracking holdings aren't frequently buying and selling stocks, how could they contribute to shortening horizons? Because they themselves are being bought and sold. With the rise of low-cost investment vehicles that can be traded like individual stocks, ETF volumes have risen to meaningful proportions of the market activity. And it appears that this turnover and activity impacts the underlying securities, with higher volatility and turnover for stocks included within ETFs, amplified by arbitrage activity, often impacting segments of the markets, like sectors, countries, and styles represented in ETFs. This presents an opportunity through active asset allocation across equity markets, and for bottom-up investors that can take more active risk by including focused exposures to these areas. The game may be opening up for those with a long time horizon and a high active share. Active share is loosely defined as how different an investment strategy is from its benchmark, which on its own is far from a guarantee of success. However, Martin Kramers, the leading academic on active share, identified that funds with high active share and low turnover tended to do better on average. This makes sense to us. For fundamental investors, time horizon seems to be the road less traveled and a key source of opportunity or arbitrage. Arbitrage typically refers to different prices set for the same asset. The astute investor can buy at a lower price and sell at the higher one, keeping the difference. Once, arbitrage involved buying something like gold at a lower price in one port and sailing to another port to sell it at a higher price. With a large enough spread, many could take advantage of the price difference, but of course not everyone did. Applying this concept to time horizon, arbitrage can be thought of as more investors are focused on the short term with lots of competition for investment results. There's less competition for information that's only relevant over the long term. Whether due to incentives or to psychology or career risk, there's a reluctance to extend one's horizon. To recap, while headlines decry the decline of active management, we may be seeing a change of active management from purely security selection to active asset allocation using ETFs for active views. As the security selection asset manager universe shortens their time horizon and increases their activities, the opportunities may well be in doing the opposite, fishing where the fishermen aren't, reinforcing one of the few durable investment advantages, a long-term investment horizon. We think this changing nature of active management is therefore an opportunity and an advantage for us at Morningstar Investment Management. Of course, we can't do this without your help. Financial advisors can help clients stay the course, keeping their focus on the long term.